Good afternoon and happy Thursday, everyone. This is Scott Wohlers with River Place Capital. It is Thursday, January the 16th. I'm going to take just a brief minute to discuss what markets have done last week, and this is our first video of 2025. And what a volatile start we've had to the year, my goodness. With markets last week down 1.94 on the S&P 500. Definitely a down week because interest rates really ticked up at the end of the week on a big jobs report. And we're going to talk a little bit about what's causing all the rates to go up and the volatility in just a minute. The mid-cap index, as measured by the S&P 400, was down 1.67%, or 167 basis points. And the mid-cap or the small caps in the S&P 600 were down the most, down 2.9% on the week, causing markets to go negative last Friday for the year off of a very strong jobs report. We got in way more jobs than we anticipated at 256,000 for the month of December, well above estimates, and that sent interest rates through the roof and caused the market to sell off dramatically. And as we've moved into 2025, there's a pretty common theme that you can open up the Yahoo Finance or wherever you get your stock news and look at the 10-year Treasury, CNBC, whatever it is. If the 10-year Treasury yield is going higher, stocks are going lower. If the 10-year Treasury is moving lower, stocks are going higher. So as we move into this week, we saw at the end of last week, off of that strong jobs report, a 10-year Treasury run all the way up to 4.81% yield, the highest since November of 2023. What caused that is the economy is actually stronger than many had feared. Adding all of these jobs, it leads to inflation being sticky around where it is, which means rates on the long term need to be a little bit higher for the premium that you're willing to pay versus the rate of inflation that currently exists. And that's why you've seen the 10-year move up. You've also seen the Fed funds rate really flatten out. As we were moving in, if you would have looked 3-4 months ago, the futures would have priced in 4 rate cuts for the year of 2025. Now many economists have priced in just 2 rate cuts in the latter half of 2025, not in the first half of 2025. So what is causing interest rates to move higher? I touched on it briefly there about the risk premium over inflation. But we do have a stronger than anticipated economy with the jobs creation that we're continuing to see, which will lend fuel to the fire. We got inflation reports this week, which were great. The PPI and CPI reports, CPI core came in 1/10 lighter than expectations, and you saw the 10-year Treasury go from 4.79 all the way down to 4.65, which led to a nice equity rally. All of this to say, as we move forward for at least the foreseeable future, the trend here is going to be watch that 10-year. That's going to be the lid on stocks, and especially your smaller stocks. Small caps have to go out and borrow money from financial institutions, and those rates are going to be based on the 10-year Treasury, and the spread above that is how those are going to be priced. Now, larger companies don't have to go to banks and go into the prime rate of lending to get loans. They can issue corporate debt or corporate bonds that the public will buy at a much lower interest rate than what they would have to go out and borrow. So what you're seeing is the yields are going to be based on that inflation rate. If you've been reading our writings or listening to us for the past 6 months or so, in the last year we've said, hey guys, I think it's going to be pretty tough to get inflation down from 3 to 2. Might get very sticky right around that 2.7, 3% range, and that's what we're seeing happen. Because the economy is so strong, people are continuing to spend money, and they're continuing to move this economy forward. And until there's a break in that, there's going to be strong economic growth, which should lead to earnings growth, which should lead to upward mobility in the market. It's just going to be a little volatile until we get some clarity. So if you have questions about how to navigate this market or what to do, just feel free to give us a call. We'd love the opportunity to speak with you. You can reach us at 904-346-3460, or as always, check us out online at www.riverplacecapital.com. I hope everyone has a wonderful rest of your week. Thanks so much for watching.